Miles, a lot of the worry right now when it comes to real estate is about the commercial market. You're involved in residential real estate. So where is that right now?
Well, it has slowed relative to where it was during COVID, but it's starting to pick back up again. I mean, the big issue is interest rates and its effect on people's mortgages, which is quite high right now. We're expecting over the next 18 months for rates to start to come down, which will pick up the volume of transactions in the marketplace. Prices, for the most part, have stayed fairly stable, recovered some of what it lost during the May 2022 kind of period. But we're seeing an increase in volume of activities. Last year, there was about 5 million houses that traded, 6 million in 2021. This year, about 4.2 million houses, and they think about 4.6, 4.8 million next year.
You keep talking about interest rates, but I thought the first rule of real estate is location, location, location. So tell me a little bit about where Peerage plays and which markets are doing well and which ones are doing poorly.
So we're a North American player. About 70% of our business is in the United States, about 30% in Canada. Our business is in the luxury space. So our average transaction is north of $1 million. We'll sell about 70 or $75 billion worth of residential real estate. About 15 billion of that is high-rise apartments or condos, as we call them up in Canada. Location is obviously critically important, but if people have low-cost mortgages, 2.5%, 3.5%, they have inherent equity in their mortgage, and it's very hard to move when they're going to pay 7% currently.
So can you talk about the demographics at play now? Because if the boomers aren't moving, it's not really allowing millennials to get their foot into their first homes.
Yes, it is a challenge. As I said, we focus on the luxury space, and so most of the buyers are older. A lot of the buyers are cash buyers for our products. You know, we're in the west coast of Florida, we're in North Carolina, we're in New Hampshire and Vermont, we're in Dallas, Texas, and Chicago and Fort Worth. We're in all across Canada. So there is a huge amount of demand, but right now there's not a lot of supply, and the shortage of inventory is really what's restricting the growth in unit volume.
So what's it going to take for the supply to loosen? Is it going to have to take a recession? Is it going to have to take a hurricane on the east coast of southern Florida? What's it going to take?
A lowering of interest rates will be very, very helpful. Not even a material amount, but just there's such uncertainty now with higher inflation and the expectation that the Fed may raise rates again. And so if rates were stable to slightly declining, I think the psychology would change. One of the things that we're doing up in Canada is very interesting to help millennials is we're in the co-ownership of housing. So it takes 20% down payment in Canada to buy a house. The average millennial has about 5 of the 20, so a quarter of it. We put up the rest of it, and so they can own a quarter of a home or 50% of a home. And that's allowing them to get into the game earlier than they would otherwise if they don't have the bank of mom and dad.
And then what about foreign buyers? Because for a long time, what really propelled luxury housing, luxury apartments in New York City has been foreign buyers. Is that still going on?
Look, foreign buyers are very attracted to the entire North American marketplace. The government has done its best to try and restrict that. But still, this is, New York City, Canada, Toronto, Vancouver. Those are great markets where it's very stable and it's a safe home to park capital. And I think it always will be for the next 50 years.
All right. Well, thanks, Todd, for coming on and talking about it.
Pleasure. Nice to be here.